Good morning and welcome back to the Short Vol Show Live. My name is David Lincoln, and I have returning to the show Matt Thompson, and he brought along his brother this time. So welcome to the show, fellas.
Hey, thanks for having us.
Yeah, thanks, Dave.
I totally didn't realize that you'd been on my buddy Seth's channel about 2 or 3 days ago when I thought about doing this. So it's kind of a coincidence that you're on there, because I know you guys don't do that many interviews, really.
Yeah, this is our worldwide press junket.
Nice. Well, congratulations on the new setup. I got some sort of message on LinkedIn that said you had new job titles. What's that all about?
Yeah, so we started our own advisor, Thompson Capital Management, and we started that. I think we were registered in April. So we're just getting going. But mainly we manage portfolios for advisors and for high net worth individuals, with each one of them with sort of a VIX flavor to it. So we can hedge equities, or we can trade VIX directly in managed accounts.
So that's managed accounts then. So somebody would set up an account, and then with whatever your preferred broker is, and then you would manage it for them. Is that the way it works?
Right. Yeah. So right now we work mainly with interactive brokers, and then we can also do accounts at TD Ameritrade.
Yeah, those are two of the really big ones. I have sort of a relationship with TD just because I've negotiated back and forth my rates and stuff. But IB is so respected as well. For some of the really smaller people that I have on IB is a minimum of $10,000 to invest, which for some of the really small people is a barrier. But for most people, they're a great choice, and have a lot of ton of people on there.
Yep.
Yeah.
So I really miss Chicago. I lived in Chicago for 12 years, and when I was on the SIBO, and I was actually a sort of gray area beer vendor for the Taste of Chicago and all the festivals. And
Nice.
so I really miss it. I continued doing that even when I didn't necessarily need the money, because it was just great to get out in Grant Park and hang out and be there in the summer.
Yeah, you haven't missed much this summer.
Really?
We haven't had a summer yet. It's just gearing up to like this week, but otherwise it's been terrible, rainy and cold. But it's the city's awesome, especially when it gets nice out.
Yeah.
Yeah. So it was. I don't know if it was coincidence or if it was just kind of blind luck or bad luck, but I had you on the show right before the Vomageddon, and I know you were referencing that in the last interview you did,
Right.
but we were, we could point back to that and say, well, we at least talked about tail risk and XIV and all that stuff right before the market down move. I didn't completely avoid, taking heat on that down move, but at least we could say that we weren't completely culpable with some of our the people that watch us about, describing the risks of being short volatility.
Yeah, that was it was fortuitous timing or inauspicious timing, maybe, depending on how you look at it. But yeah, no, it's always just important to know what you're trading and understand the risks and manage them.
And we're in a really different environment than we were at the tail end of 2017. And a lot of the smaller sort of short vol people then were like really comfortable with always being short some of these VIX ETPs, and really hadn't experienced a big spike. And since then, we've had, not just that Vomageddon, but last December we had some real volatility. And it seems like the range has kind of moved up since then as well, where like, I know in like 2017, VIX got to 14.5 and it was going straight back down from there. But now it seems perfectly comfortable hanging out around 16.
Mm-hmm. Yeah, to us, it feels like Vomageddon was the start. It was kind of the beginning of the end of that low volatility era, and I think there's a big kind of slow moving change going on towards the gradually higher deck for vol. And so you've kind of seen it in these waves. You had Vomageddon, then you had December, and each step is slightly higher in vol, and it's sort of flattened up the curve in general. So the short vol trade is still there, but I think it's just the risk reward is changing a little bit as vol's trying to find this new kind of floor.
Well, I want to pick up on something you were saying with the Wayne interview, which I think was really spot on, and that is that like you can call yourself a long vol or a short vol trader, but in the end, you need to be either on the sidelines for about half the time on either of those strategies, or you need to really pick your points because the ranges move back and forth, and it's not easy by any means. I don't think to trade the VIX back and forth. Just picking one strategy or another.
Yeah, completely agree with that. I think our overall philosophy is you need to have a dynamic approach to any vol trading system.
No, for
either that or really deep pockets and a really long time frame.
Right. If you have a very small percent of your holdings that's short vol or something, and it's super small and can weather the storms, then by all means, I guess go to it.
Right.
So with people getting scared that we're reaching a top, and you hear all these people saying, "Well, the bull market's long in the teeth and everything." I think people are looking more and more for alternative strategies, and I certainly have kind of latched onto this fund USMV, which is a low volatility component, or a low volatility fund, but it has a volatility component. And I know that you have some products that feature that component. Have you noticed that investors are more and more looking to add some sort of VIX component to their long holdings?
Well, yeah. So we've heard a lot about the USMV ETF. It's done fantastically well. That low vol kind of factor has really done well recently. So it always gets a lot of attention. I think in terms of people inbound kind of looking for VIX strategies, maybe not VIX specifically, but that definitely as people get nervous about whether or not the stock market can keep going on this tear that it's been on for the last decade, they start to look around to see what else is out there that can potentially, help if stocks stop going up.
Yeah, we've seen decent interest in our hedged S&P index product, what we call Smart Index.
Mm-hmm.
And that just takes kind of the long vol side of our signals and hedges a normal, S&P 500 kind of passive allocation. So that did well last year. So that we've seen additional interest there after the fourth quarter, kind of punched a lot of people in the nose, if you will.
How do some of your managed accounts work? Which products do you trade with those? Is it VIX ETPs and index ETPs, or do you use individual option strategies with different strikes with VIX options, or what sort of products do you use for those managed accounts, or does it completely vary?
Well, so at Thompson Capital, we manage 3 separate strategies, all based off of what we call our volatility dashboard, which is kind of just like a weather vane for VIX. Is VIX rising or falling? Is it risk on or risk off? And based on that output, we'll go in and manage our portfolios. We've got one strategy that is called Alpha Seeker that just trades the VIX ETFs, long or inverse. And then we've got our second product, which Mike mentioned, is called Smart Index, which is S&P 500 indexing with a dynamic risk overlay on top of it, so a hedge. And then our third product is kind of a diversified mix of those two. So it's Alpha Seeker, Smart Index, and then some bond exposure as well. So it's kind of a one-stop risk managed portfolio for someone who wants to be in the market. And each one of those uses ETFs exclusively. We are sub-advising into a hedge fund that can use a lot more products, and we use options and futures and everything in there. That's a separate product.
What I know that you're sort of infamous on Twitter for a lot of statistical analysis and your insight. Is that sort of a major component nowadays of marketing for you? Do a lot of your customers find you on Twitter, or do any of them? Because it seems like it would be helpful to you doing that stuff.
Yeah. So, I mean, I built a Twitter following just based on, I think, the information that I'm providing to people. So I'm hesitant to turn that into, just this like feeder thing for Thompson Capital or whatever. So I'm trying to keep those two worlds separate. Thompson Capital does have its own Twitter feed, which is it's a little drier. It's gotta be a little bit drier there. So I'm trying to keep the Twitter thing just informational, and it's been actually a good marketing tool just because you can send people out and show them something that we're doing without selling them really hard on you should do this or you should do that. But yeah, no, it's a good way to sort of just get the name out there, and yeah, it's probably going to stay that way for a while.
So, have you been expanding a lot, or what's the goal? Is to raise your AUM over time and just build a bigger and bigger amount that you're managing? Is that your goal at this point, or is it to expand your strategies, or what are you focused on right now?
Yeah, tell them how we're going to build the whole empire.
Yeah. The goal is some sort of world domination. But yeah, that's it's a pretty simple business model. Being an RIA is AUM produces the revenue, so we want to grow kind of prudently. But yeah, that's the end goal: is good performance and increased AUM, and just wash, rinse, and repeat, and just keep at it.
Yeah, and I would add that so our strategies are what I just described, and we're looking kind of our next phase of growth would be in the way we offer those strategies. So we're looking at potentially doing an ETF or some principal protected notes that involve our strategies with a principal protection wrapper around the top of it. And so I think the next sort of phase would be expanding the reach of those strategies for people that can't use or don't like separately managed accounts for whatever reason.
Well, I think a lot of my viewers would be interested in some sort of option with a sort of a lower barrier to entry, because I know many of your strategies you need to be either a qualified investor or at least have a decent amount of capital to make it happen. And that's true for a lot of the people I have on this show, but we're always looking for ways that a smaller person can get involved.
Yeah, so if we had an ETF at some point, you'll see a ticker out there, and you can go buy it with $50 if you wanted to. So we're hoping to get to that phase someday, and that I think we're actually in pretty advanced talks with a firm to get that done, and maybe by the end of the year, potentially you might see a ticker.
Well, that's exciting.
Yeah.
Yeah. So the VIX hasn't been around very long. It's only been around since, I don't know, the mid 90s. And every time we get a big down move, like maybe even the move in December, people start saying like, well, we don't know enough about this product to be able to say that, like something like, well, we're always we're in contango 80% of the time or 85% of the time. These things haven't really been tested that much. And you hear people saying, well, maybe we're going to go into backwardation for long periods of time. I tried to explain to people mathematically that really can't happen for too long, but with such a young product, do we have to wait longer for more data to be able to really understand the VIX better, or do you think that it's matured enough that people can kind of really have sort of a true understanding of it?
Well, I mean, so the VIX index, has been around since the 90s. The tradable products really started 04, and in reality, kind of 06 when the options listed. And then obviously the ETFs are even shorter time frame than that. And so the ETFs, I guess we'll start there. They started in 2009, mostly on the long side, and then these inverse ones came along. So really the market, the window, the true data for these ETFs starts in 09. And so from 09 till now, you've got 10 years of basically an upward trending market and pretty calm vol with a couple, spikes in there. So I would say the 10 years that you can look and observe VIX ETF data, it's kind of like one big observation when everything's going well. So I think the data set gets complete the next time we have an actual earnings recession or a recession and a bear market in the United States. So you have another 01, 02, I guess another 2008 or something like that. I want to see those products trade through that kind of market and feel a little bit better about the full data scope.
Does it? Yeah. Does it bug some of your customers and also you the kind of funny business that happens on expiration with the pricing of these products? And I know that there's been several alternatives that have been sort of brought out, like the spikes and other sort of products that are similar to the VIX because of people's frustration with not only the Volmageddon, but just expiration day shenanigans. And I know it doesn't apply a lot to the ETPs because it's kind of moot, because usually those futures are pretty much rolled off of what's included in ETPs. But still, it seems like there's it seems kind of like there's some sort of manipulation on expiration. Do you feel that way, or how do you explain that to people?
Yeah, I think your point that the ETPs really don't play into expiration is our main point. So it really is just like a kind of a PR thing or a more of an aura thing around. It makes for good stories, right? Or clickbait to talk about manipulation and expiration, all that kind of thing. In reality, the money that changes hands on expiration, has really got not very little to do with how we trade or how most other people trade. That's kind of the realm of the market makers and prop firms and that kind of thing. So it's just more of a, reputational thing around the product itself, as opposed versus its actual impact on our strategy or other strategies. So we don't play in the expiration game. So it other than a PR thing, it doesn't really affect us.
Yeah, and it just adds to the, there's a lot of misunderstanding around these products just anyways. And then when you throw in something like that and people hear that word and there's been lawsuits brought, and it just sort of, it just adds into that mix of like, well, I'm not quite sure about these products sometimes. We heard that around the Volmageddon period. We had people asking, did somebody manipulate that to make that happen? And no, understanding the products, had nothing to do with the settlement issues. And so, it's just one more sort of educational hurdle to us.
Yeah, I mean, I get that all the time and I read on the chats all the time, like, oh, market makers are holding this stock up above this strike because of and there's all this, having been a market maker for a long time and totally feeling like I had no control over any situation whatsoever. I definitely am, don't believe that there's all these conspiracy theories at all. I know that like every once in a while there's a pocket here or there that, something can move a little bit, but that's not like people who are trying to move stuff in that way are taking big risks themselves to do so. And, there's not all these conspiracy theories are a bunch of hooey as far as I'm concerned.
If the question is, are there people out there with a lot of money that try to influence prices in a way that's profitable for them? Yeah, that happens all over the place in tons of different markets. And yeah, there's probably been scenarios when, the expiration in the VIX has, been under that umbrella. And, you just have to understand that and know, what you're trading and if you're exposed to that risk or not.
Yeah, I always explain to people that the VIX is based on strips of options in the SPX, and that the SPX trades a lot more than any of these VIX ETPs and options in the VIX ETPs. And so that to worry about open interest in, like, say, UVXY or VXX is putting the cart ahead of the horse. But it seems like people are getting more sophisticated these days and coming in different ways to do different things. And so I wonder, is that the way you see things, that everything is driven off the SPX, or is there a more sophisticated game going on here? I know that last time I talked to you, and when the XIV whole situation was going on, there was a ton of open interest in some of these VIX ETPs. What's the situation right now? Is it much more open interest in the SPX, or how does that dynamic play out as far as you see it?
I think just across the board, the AUM in the VIX space is down. Obviously, from Volmageddon Day till now, the open interest in the inverse ETFs, especially after the deleveraging that SVIXy did, it's like 90% smaller than it was when we last talked. And so that obviously is going to affect the way the VIX futures market trades. And, it's a lot less it's kind of gone back to where it was in 2009, when most of the AUM was in the long ETFs, a vast majority. And so that, I think really what we're seeing is that the futures market, VIX futures market, and the ETFs have taken a step back in terms of their influence in the overall market, and that leaves the S&P options flow as a predominant kind of factor right now for VIX. And I think what we've been hearing, there's been quite a bit more systematic volatility selling in S&P options and S&P puts, kind of tracking that put right index that SIBO puts out. So the predominant factor for VIX recently has been since Volmageddon has been from the S&P options flow.
Yeah, it's just such a vastly larger market, the S&P options, than the entire VIX complex. That it is, massively different in terms of size. So the S&P is the big kahuna, S&P options, when it comes to pricing vol.
Yeah, I heard something like 80% of the trading in the world goes through the SPX in one way or another. I mean, it's that big. I'm not just talking about options, obviously, but it's that big of a thing. Because I had a viewer asking me questions about like, oh well, if a few people start buying puts in UVXY, then isn't that going to like move the whole market? And I said, well, that's not really the way it works.
Right.
Yeah, I mean, let's say that somebody with enormous pockets can come in and push the VIX up using some method, and they take a 12 VIX to a 15 or something like that just because they want to. Well, that gets reflected back to a much larger market, S&P 500 options, and as the market maker, you're not going to stick around for someone telling you what price your options should be at. The VIX is the tail, not the dog, and so it really would be a very almost impossible maneuver for you to kind of go back upstream that way and affect S&P vols and the VIX by trying to trade some of the derivatives of the VIX. It's a tough situation.
Well, also there's just not enough liquidity in the options. I mean, they'll just fade you if you try to do anything big in there, to the extent that it's just not you can't get it done. Is what it comes
Exactly.
down to. Yeah. So. Yeah, I've noticed that liquidity has really dried up in UVXY since the Volmageddon. But in a way, it's a good thing for me as a short vol guy that more people are like using these things to get long, because it means that stuff doesn't get bottled up on one way or another, and it creates it's there. That's where the opportunity is. And the same thing for like confusion over expiration, all these other things. These are the things that create the opportunity for us, and for the people that are your customers, for example. That it's not understood so well by everybody.
I like the fundamental like underpinning of that trade is kind of always there. I mean, it ebbs and flows, but there should always be a premium, a volatility risk premium. There should be, there's VIX today, and then there's the thought about uncertainty in the future, and there's should be a premium there all the time. Sometimes it does shrink or even go negative, and we've kind of seen that more often recently as maybe the market's trying to find this new deck, but it doesn't mean that it goes away forever, and it doesn't affect the long-term outcome of like shorting vol over some time.
I had this guy on, Mark Sebastian, and he was a SIBO market maker with me at Group 1 Trading at one point.
And we know Mark.
Okay, well, he was describing how like he has different like zones that the VIX can be in, and initially he had one zone where like is most of the time when VIX was hanging around like 12.5, 13.5, and nothing's really happening, and we're just kind of in contango and we're slowly rallying. And then there's an elevated, and he had different kind of levels, and I think he's kind of moved them up now a little bit. But do you see things in that way as well? I mean, do you shift gears when stuff goes into backwardation, or I guess that's part of your proprietary model in a way, but
yeah. So at a sort of high level view, our model just has its own way to measure contango, flat, or backwardation, and the sort of nominal price of VIX. We've all seen that deck rise versus like a 2017 when it was all-time kind of average low for spot VIX. When you think about it, it makes a bit of sense. We're just in a different economic environment now. There's all sorts of there's no shortage of worries about recession, whether it's earnings recession or outright recession. And the curve has sort of reflected that, being much flatter this year and presenting less edge for short vol trade. It's been more back and forth and two-way trade. So the deck has certainly moved up, and term structure has flattened out a bunch this year, even with the S&P rallying. So it's a large modicum of doubt, or just saying, all right, S&P's rallied, but that was a low base effect coming off the fourth quarter. I'd rather, sort of indicative of a buy and hedge approach to S&P market as opposed to not using hedges. So people are afraid to miss out on a bounce back rally, but they want some protection around because these kind of general macro worries out there, and then all the event risk, G20, Fed changing their rate hike cycle into this patient cycle, and now maybe rate cuts. So the activity makes sense to us, but you see it reflected in higher VIX deck and flatter VIX futures term structure.
So the strategies of your fund is essentially to always be long the market, but then to sort of hedge it in different ways. Is that?
So that'd be the smart index strategy.
Okay.
So that is our nod to this massive move to passive indexing. So we want to be in that game. We just want to do it in a more thoughtful manner. It's very expensive to have an always-on, option-based hedge, kind of pay through the nose and premium to have that certainty or that line in the sand. So our approach is let the S&P be the S&P. We will write some covered calls from time to time, produce a little bit of income. But when we do have a long VIX signal, or the conditions are in place for a long VIX signal, we'll leave the S&P alone, but we'll start buying, some of the VXX or TVIX or those types of long VIX exposure on a tactical basis. Long VIX is almost always a short-term rental as opposed to a buy and hold. So that's our approach on the S&P product. An Alpha Seeker, where it's just the pure VIX trading, we are either going to be long vol in some form, generally through all those ETFs, or we're going to own one of the inverse ones if we have a short vol signal. The curve's too flat, we just won't play. We'll be in cash.
And that would be a great alternative investment for people who are just really long.
We want to produce a return that's not correlated with stocks and bonds, so we can kind of grind up with stocks when things are going well. When the curves contango, we're going to look a lot like the stock market, and then when things reverse and the curve is inverted, we can be long vol and make money as the stock market's falling. So you end up with something that can kind of be like an all-weather type portfolio that is just another nice piece to have alongside stocks and bonds.
Yeah, I was reading something that was talking about how bonds and stocks are actually highly more correlated with each other than the sort of common public wisdom is, and that there's a need for more than just, okay, we're switching from stocks to bonds, now we're switching from bonds to stocks type. That was like the old style.
They were both down last year. So if you can imagine a scenario where that happens for over an extended period of time, it doesn't matter what your mix is, that portfolio is not going to do very well. So our thought is, you can keep your 60-40 mix largely intact, give us maybe a 10% out of your stock portfolio, put it in the Alpha Seeker program, and things sort of just get better more often. Kind of your risk scores improve.
All right, well, let's just have some fun for a second. So, Mike, you are the Fed. Are you going to cut rates this year?
This year, so I think and
the president's not going to. President can't touch you.
Trump said he would rather have Draghi in there today than Powell. So yeah, as the Fed, I think they're reasonably invested in this patient narrative that they've been talking about since the turn of the year. I think Powell's speech yesterday made it sound like, all right, we're going to be data dependent. We're ready to use all the tools at our disposal. I think the Fed's going to listen to the Fed fund futures market going into a meeting. Matt and I were looking at the stats yesterday. They've only missed, Fed fund futures market's only missed one time when it was predicting, was it greater than 50% chance, Matt, of a rate cut going into a meeting? So July is priced at a 90+% chance of a 25 basis point cut, I believe. So I think you're going to see rate cuts this year, and they are going to go out of their way to make it look like it's a 95 or 98 insurance cut, if there is such a thing. But that's the the narrative being used. But I think since they are so invested in this patient narrative, we're not going to get 50 basis points in July. I think Bullard made that clear yesterday. That would have too much of a whiff of panic to cut 50 at the first meeting. So I think you're going to see probably 25 in July. They're going to say we're patient, wait and see, data dependent in probably 25 in September.
Yeah, I mean, I think that, I personally think that Powell just really screwed up. I think that first time when he said we're going to have 3 or 4 raises this year or something in the next year or so, and then the market sold off, and they said, well, they weren't data dependent enough. He wasn't paying attention to everything, and then I feel like he just caved right after that. And that if I had been the Fed, I would have stayed on a stance of, if not raising, at least not going to lowering so quickly. I think it's ridiculous. I think the economy has done well, and we shouldn't be. We should have the leave those things as available resources if things really go bad for us. If we lower rates now, then it takes away a tool for if the economy does badly. And I know they've been forecasting and all this stuff, but it seems ridiculous to lower rates to me. But I'm not the Fed and I'm not the market. It seems like it's a short-term thing. Like, let's make the market rally today. What can we do to make the market rally today? Right. Okay, we're going to cut rates. Well, pretty soon, when do we ever get rates back to normal if we can't have them normal now, when the market's at all-time highs and the economy seems to be doing well?
Right. Yeah, I don't know why the Fed's terrified of a normal business cycle, but they are. They're trying to iron out, all types of normal recessions. And the end game of that is yet to be seen. The end game hasn't played out in Japan, and they've been at extremely low nominal rates for 30 plus years now. They have their own demographic challenges, but I would agree with you. The short-termism just seems to be endemic. In everything, Fed policy, in investment choices, everything seems to be very short-term focused.
Yeah, I was just gonna say too, it's kind of the double-edged sword of the Fed trying to be more communicative, trying to be more open and transparent. They're winging it just like everybody else, does. And so to hear all of the, the back and the forth and it sounds like they're confused is because they are. And, they didn't used to be where they would have press conferences and telegraph every little thing and put dot plots out. And it just sort of, they probably meant well with that, but I think people can there's so much stuff to parse here now for the market, where you can react to every little thing. And it'd be the analogous thing to have a client standing over my shoulder when I'm trying to make trades in a portfolio. There's all this information that's always changing, and you change your mind a lot, and it's not 100% transparency is not always super helpful.
Yeah, I totally agree with you. I think the Fed needs to be the quote-unquote adult in the room. They're made independent for a reason, so they won't have these immediate political pressures on them and all the things that, for example, the president has to deal with, all these people pulling on them. They're supposed to be able to kind of look at things from above and from a certain amount of detachment, and telegraphing every little feeling is not detachment. And, all the things that they got criticized for after the market sold off, after that first cut, are wrong to me. I think they should be a little bit detached. They can be optimistic even when the market goes down yesterday or something, and they should be have a quiet confidence all the time and be always sort of optimistic in a way. I don't know. I know it's very hard to talk and get into politics, especially when you have a customer base, because people get into this partisanism stuff, and the way I try to get around that is I say, well, if the president only had to deal with the economy, he might not want the rates to be cut, but he's got so many other things pulling at him, and because it seems like a lot of people, whatever Daddy Trump says, they're just going to agree with right away, and it's very hard to have an intelligent conversation sometimes with the tribalism that we've come into. How do you deal with when you have a customer who's on one side or the other of the aisle and wants to talk politics to you? How do you handle that situation?
So my favorite go-to line on that kind of thing is like, look, my politics are capitalism, and in general, that's sort of the best way to approach investing. That's what's best for your portfolio. To take a risk with money based on a political view sort of leaves a lot of it puts dogma in front of logic a lot of the time, and so you could end up feel good about short if you're anti-Trump, being out of the market or being negative on everything in the face of the last couple of years the market's been strong and the economy's been strong. So if you want to have better portfolio value, sort of try to leave the politics and the dogma out of the investment making decisions, and sort of focus on the facts on the ground and that kind of thing.
Yeah, thankfully we don't have. I can't think of any of those types of conversations we've had. We try to. We have a quantitatively based system that looks out. The VIX is looking out the next 30 days, and so like almost literally we care about sort of what the market is telling us about the next 30 days in a quantitative way. So obviously politics does play into that, and there are ways.
Yeah, I've never
change it, but
I don't think Matt or I have ever made an investing decision where we look back and said, "Gee, I wish I would have been far more emotional about that decision." It just, it just doesn't play that way. So I think the process we have in place just looks at market prices and the relationships and prices. So it takes a lot of that the view, through the lens of politics or emotion out of the decision making,
right?
Which over time is healthier if all you care about is trying to make money.
Well, it's always been a question in my head, which is not really answerable even, but how much does the president of the country actually affect the economy in the end? And it seems like the economy goes in sight. If you look at the economy as like going in waves, then in the same way that Bill Clinton doesn't get credit for running at a surplus, and the economy being great. Well, the same way, I don't know, George Bush doesn't get the blame for a bad economy or something like that. I don't think the president has as much of effect as it seems minute to minute.
Yeah, I would agree with that. There's always a lag, and there's so many other things that affect the economy besides like what the president wants to get done, and sometimes he may or may not get that done, and all of that stuff comes in with a crazy with long lags, and I would say that the Fed is way more influential in terms of actually changing conditions, at least for asset prices, than the president. I think this president's trying to be highly influential on the S&P 500, on asset prices, but it's always tricky to say in a $14 trillion economy that that one guy's like thoughts changed everything for us in 2 years or 3 years or 4.
Yeah, I mean, do you think? Well, I don't even want to. I'm just going to ask you this question just to see what you say. But is it better for investors to have Republicans in control of the situation? It seems like that's like the conventional wisdom. Do you think that's true? I'm trying to get you guys in trouble here. You don't have to answer.
I'm sure Twitter can show you all the stats on like market returns for Democrats versus Republicans. I can't remember actually which one out, but
I don't know either.
Yeah, I think in general, asset prices like freer economies, lower taxes. So however you want to vote.
Yeah, I think most people who are market makers or in the finance world just want deregulation of the finance world for themselves. That's the biggest political thing people want.
Yeah, that's what I was thinking of. I think it doesn't matter if it's Democrat or Republican, if the marginal effect of that president is to ignite animal spirits in the economy and make an entrepreneur feel like they can actually, produce and run a business and that kind of thing. So whether, it was Clinton being, kind of a pro-business Democrat, if you will, to some extent, the deregulation and just the ability or the feeling that you have the ability to run a business without it, the bureaucratic red tape or cost being too high. Doesn't sort of matter what party is in there making that environment available, basically.
So was the Vomageddon, was that the biggest VIX move we're going to see in the next 10 years, or do you fellas anticipate a
10-year
spike
forecast?
coming up? Yeah. Should we expect more volatility ahead or less, just sort of in general?
I think so. Volmageddon in particular was, to me, that wasn't a normal natural VIX spike. That was heavily accelerated by the market structure in place at the time. So,
Can you explain, just for people who maybe are brand new to this channel, kind of just in broad strokes, what happened in Volmageddon, just so that if somebody's new to maybe watching the VIX, I'm talking about like what happened to XIV and how did that propel the VIX higher in that moment, or that hour after the close or whatever.
Okay, so in early February, you had $3.5 billion, maybe more, in the inverse VIX ETFs, and their exposure got to be bigger than the long VIX ETFs at that point, right before Volmageddon. And so what happened was on February 5th, there was a big enough VIX spike where it forced those ETFs those billions of dollars to basically have an enormous buy order at the close of the market, just to rebalance their exposure and track their indexes. And they basically rebalanced themselves out of existence because they pushed up the futures so fast with so much demand that the notes, so if you're short a VIX future and it goes up 100%, you're going to be at $0. And that's effectively what happened to those guys. Because of their own demand in a bad day, they sort of took themselves out of the market. And so I think that's what I was referring to. The VIX spike was there for whatever reason. I don't even remember what was going on around that time that caused VIX to kind of jump up originally. But were it not for that $4 billion that had to crowd into the VIX futures at the end of the day, it would have been a kind of run-of-the-mill VIX spike. And so now, post that event, that AUM is all gone. That $4 million is down to a couple $100 million. That fire is not there for that particular February 5th repeat. But of course, you're going to see big VIX spikes in the next 10 years on something. I think in the next 10 years, I'm real confident to say we're going to have a bear market at some point. I don't know if it's next year or 2 years from now. And during that bear market, depending on how jammed up credit gets, that'll determine how close we get to another 2008 type scenario. And in those big liquidity breaks are when you get the kind of disjointed VIX moves and backwardation for like 3, 4, or 5 months. So it remains to be seen how well they can kind of maybe this is why the Fed is trying to stop the business cycle from completing this time, because there is a few more turns of debt in the system since 2008, and that's just a shakier foundation. So along the way, I don't know. We will see more VIX spikes. I think we'll probably see 40s and 50s in VIX at some point in the next 10 years, as we hit a recession and we hit some sort of pain point in terms of a deleveraging type of cycle. It's impossible to say. That's why we're looking out 30 days at a time. We'll take it a month at a time.
Fair enough. Yeah. So I know that Wayne took a stab at this, but I'm going to try too. How do you divide up your duties between the two of you? And is it hard to work with a family member in a business?
Well, we got all our fighting out of the way when we were kids, so I think it's uniquely beneficial to work with a family member in this industry because you have that sort of implicit trust. So we've been working together at various places since 2003. It is obviously highly competitive industry. So I think there's a unique advantage to working with someone that you implicitly and explicitly trust completely. And then duty-wise, we're on kind of chat, like private chat like this all day. So we, generally the signals don't change too often, but they can change, pretty rapidly. So we're talking about current positions and proposed positions. keeping track of the news flow and that kind of thing. So I think we basically divided up kind of 50-50. Matt kind of does most of the trading. I work on some biz dev stuff and that sort of thing, and do some of the trading as well. But it's really collaborative effort. And really, at the end of the day, it's talking about positions, proposed positions, and kind of scenario analysis. And so we already know our war plan, our game plan, coming into each day, and as things evolve and change.
Yeah, and the nice part is with technology these days, we can run a big book with just a couple people, because we can trade. At TD, for example, we have probably 800 something accounts, but we can trade them, in a big block account and allocate it out automatically with TD's infrastructure. So it doesn't take a team of 10 people to manage this book of business. So it's kind of nice.
Yeah.
Yeah, that gives me a little bit better idea. So what would you say? I have some viewers, a lot of followers who are smaller. Maybe they're just getting into trading, or maybe they're just hearing about the VIX. What would you recommend for somebody who is maybe just got out of college, has, I don't know, $5,000 or $10,000 and wants to get involved with the VIX and whatnot? What sort of path would you suggest they start to follow to build their wealth?
Well, I think there's a lot of great educational stuff out of the SIBO's website, and Russell Rose has written some good books about trading VIX derivatives. So kind of like start there to get the lay of the land in terms of VIX specifically. But I think there's really no substitute for experience, and so I would say start small and just get in there and start trading and making mistakes with an amount of money that you can live with, losing, and then you sort of get. That's the only way to get a good feel for that market.
So, yeah, I think.
Go ahead.
I think if you want to try to make trading either a profitable part-time gig or even a full-time gig, I think getting away from the mentality of trying to hit a home run or a grand slam with every trade is very important. I like this idea, or this terminology we use, of like kind of blue collar alpha. This series of singles and doubles really adds up over time and makes trades that don't work out palatable in terms of loss. The home run hitter mentality works in baseball, but you're not going to get a big contract in trading, if that is your approach. I've always heard, and we've been taught when we were on a prop desk at EDF Man, good trading is boring daily, interesting weekly, more interesting monthly, and exciting yearly. So I think if you just take kind of you need to come up with a process or a strategy that works for your mental mindset, and try to make just incremental gains over time. If you do the math on making $100 a day, over 250 trading days, you can see how things start to add up. So the home run hitter mentality, I had to learn it myself when, right out of school and getting into trading at first. It can be exciting. And the worst thing you can do is hit one or two home runs right out of the gate and have that be your approach. You're going to get burned.
Yeah. Yeah, it's like winning a scratch ticket or something. I won 10 grand on a scratch ticket, and I better.
Right. Great. Look at my return.
Yeah. Yeah, exactly. Do you guys ever trade other stuff, like personal, like for your account? Like, do you go, oh, well, Apple earnings are next week, I think I'll jump in on this, or that kind of thing in your private life, or do you pretty much stick to just the VIX stuff?
So my liquid net worth is just in our strategies. It's in AlphaSeeker specifically, and then we do have a family partnership that can do a little bit more things, and so we'll pick individual names that we're interested in as a small flyer type positions. We can do that, but mostly we really do like the statistical edge of a strategy like AlphaSeeker. Trying to harvest that volatility risk premium to us is the most consistent return in market. So there's no reason to kind of go outside that.
Well, I'm sure your customers are happy to hear that. If you're willing to put your own, you should be willing to put your own money in your own strategy. If other people are going to, definitely.
We think it works over time. It does not always work in every time frame, but it works. And I'm sticking with it.
Nice.
Exactly.
Well, we will hope that every interview with you is not a harbinger of some sort of crash. So,
Yeah, right. Don't blame me if something breaks.
And actually, I did talk to you. I was looking back. I did talk to you. You were at some options conference, and I did have you. I phoned you at the conference in Florida or something like that. So it's not like every time I talk to you, the market goes south after or something.
Right.
But all right. So nice to meet you, Mike. It's great to catch up with you. Like I said, I do want to get back to Chicago and maybe take you guys to Gibson's or something when I'm in town. Would you accept a meal from me if you're going to town?
Absolutely.
Awesome. Well, nice to talk with you, and I will leave links in the description, folks, for you to check out these products from these gentlemen, and I also will leave links to the Dynamic Vol on Twitter. And thanks for coming on, fellas. And thanks for watching the show. And we will see you next time on the Short Vol Show Live from Cape Cod and from Chicago. Have a good one.